We thought we'd do just a quick recap. We just wrote our strategy paper for the winter of 2015. It's called the first 6 months of the year, where we see opportunities. 2015 is going to be a tough year, we think. It's going to be great opportunities are out there, we find, but we would be highly surprised if people don't struggle on the investment side this year. So we're not buying indices. We are going to buy certain subsectors of the market where we see opportunity. Energy, very volatile. Energy is not going to rebound. Oil prices are down to $50, sub 50 last week, above 50 yesterday. We think it's going to be it's not going to be a V-type recovery, so it's going to be very difficult to predict the bottom and anticipate when equity is going to rebound. So we're just going to leave it until June, July, at least 6 months to see things settle out. On the other hand, the gold stocks have been beaten up over the last 2.5 years, 3 years. There's very good value in the gold place. 3 particular companies, it's fantastic. I mean, you look at the 40 different equity opportunities in the gold space, and it comes down to 3 are making money, trading at low multiples, and have growth opportunities. So I don't know if we want to talk particular names, but we've got it here in our report, and Klondex is our favorite. I mean, the stock trades at 10 times earnings with very little debt, and gold's been washed out. We think gold's going to continue to mount, especially with the euro falling, Canadian dollar falling, the ruble falling, and I think the dollar looks strong. Yet gold is held up quite well. So that's an interesting space. Forest product stocks. I've been saying this now. This is our 3rd year. We will say exactly what we said 2 years ago. The forest product stocks offer the best value in the resource space. Period. Buy any of them. But we like West Fraser. Interfor is our favorite, but Canfor is the cheapest. Buy all 3. By the way, they're already up substantially this year. We're only first week of February. They are going to be the top performing stocks in the resource space again this year. They were last year, and they were in fact the year before. Nothing's changed there. We're not so bullish on real estate in Canada. I would avoid the REITs. In fact, if you're going to play real estate, why wouldn't you just go play in the U.S.? There are a couple of companies that listed in Canada but the entire real estate play is in the U.S. These offer the best opportunities, so we're going to do a little bit of that. In general, real estate's not, I don't think, going to do all that well. Canada economy, not going to do very well at all. Avoid everything related to the Canadian economy, and frankly, just focus on everything related to the U.S. economy. So, by the auto part makers, Magna, MRE is our favorite. I mean, the stock was up 5% yesterday and 5% the day before. I think the world's catching on to the fact that MRE, Martinrea, is the cheapest auto parts company, I think, on the planet, but certainly in North America. Stock trades at 8 times earnings. I mean, listen, there's lots of circumstance around it, but the truth is it's a great company, great value, and growth opportunities, not much leverage. That's our favorite. What else can I tell you? We're playing the currencies. The Canadian dollar's going lower. Canadian dollar, basically at one point last week, was going down $0.01 a day. I mean, it is very clear, I think, the intentions of our government to lower the Canadian dollar, make us a little bit more competitive to the U.S. We've been saying this. I went on BNN 6 months ago, and when they asked me, well, how low can I go? I said, I'm not sure, but the direction is down. I got the direction right. If I had said it's going straight to 86, they would have been in shock. I thought it was going straight to 86. Well, it's already at 89. So, I mean, it went from 110 to 89 in all of 12 months. So this is kind of dramatic. I don't think that trend's going to stop for a while. Now, I may have a bounce here and stuff, but basically you want to, get out of Canadian dollars as much as possible. Of course, you can't do that living in Canada entirely. But our fund of the $40 million, we're running a little over $40 million. We have Canadian shorts of north of 20. So we've got a big short position in the Canadian dollar. I'm very comfortable. I think it's going lower. What else can we tell you? We're still short the euro. We're short the Japanese yen, and basically we believe in a strong U.S. dollar. This has profound implications for a whole slew of companies in Canada. So, basically play anybody who can benefit from a rising U.S. dollar. What else can I tell you? We were up 18% net last year. So we achieved our goal. Our goal is to get 1.5% per month. That works out to 18% per year. We actually hit 18.03. It was a complete fluke, of course, but had a good year last year. I think we're going to have a good year this year, but I do anticipate greater volatility. And that's why you want to invest in hedged product. This is why we set up a non-levered hedge fund. You play the volatility, embrace the volatility. And what else can I tell you? You're welcome. Yeah.
Global themes, which country is going to...
Yeah, U.S. economy is one of the strongest themes. Everybody's telling us China is slowing down. Well, sure, it's slowing down. I mean, a lot of people, I think, hope it slows down or want it to slow down. Listen, the Chinese economy is going to grow for the next 30 years, so get used to it. Now, how much it grows by, I'm not sure. I'm not sure we believe the stats anyway, so we don't spend a lot of time worrying about it, but I think China's growth is not stopping. U.S. is going to have a good year. U.S. economy is going to pick up. Lots of opportunities in the technology space, lots of opportunities in the healthcare space. I mean, our biggest hit last year, well, our two biggest hits last year was we recommended Concordia Healthcare in January, this time last year. We recommended in January, the stock was at $7, $8. It's a play on purchasing drugs in the U.S. market primarily. Stock went to $56. Okay, number one performing stock in the TSX board. Unfortunately, we sold a lot out at 23, and we thought we were heroes. 7 to 23 in 6 months. I thought we were heroes. Well, it went to 56. But the other one we never sold was PHM, Patient Home Monitoring, and we helped finance that company back at 15 cents a share. The stock's at $1.03 today. I think it's going to $1.50, maybe $2 this year. Terrific patient home monitoring, taking care of chronically ill people in America and doing it remotely or from abroad. It's a great theme, great business, cheap stock in many ways and high growth opportunity. So healthcare, but healthcare focused on the U.S., terrific opportunity. Small cap, there are lots of small cap opportunities, Canadian, $50 to $100 million companies that are completely misunderstood or orphaned here in Canada. Again, cheap, we think good valuation, cheap valuation with a play in the U.S. We think we're going to make money in a whole slew of them. And feel free to call them, we'll chat about them. They're all in our fund.